Maui. So look, all we want to do here, because my eyes are going to roll back into their sockets with the complexity. So I think all we want to kind of hit here is just kind of a quick, kind of a back of the napkin, kind of how would you kind of look at this? How would you calculate your taxes? Heidi, you've got a good look over here, folks. If you want to know more, you get the you do get the newsletter, right? You're on the newsletter. You did get invited to the show. Reply back to me on the newsletter, and I can send you these slides so you can see these details. But Heidi, why don't you give us a quick overview of what how would you calculate property taxes on Maui, really quick?
Sure. Well, great news. Even though it's tax day, it's not property tax day. Our tax year goes from July 1st to June 30th, and property taxes are due in February and August. And as you can see on this chart, their properties are taxed based on how they are being used. And there's all these different classifications. The highest property tax rates are going to be for timeshare, which is almost 1.5% of the value, short-term rental, hotel resort, and then owner-occupied is significantly less. So I'll just do a really quick illustration for $1 million house. If it was owner-occupied, and then I'm figuring in the $200,000 tax exemption that you get, you might be paying about $2,000 a year in property tax. If it was a secondary residence, it would be about $6,050. If it was a long-term rental, it would be about $4,800. And if it was a short-term rental, about $11,150. So, I mean, there's quite a variation based on how the property is being used. So anyway, I'll leave it at that, but yeah.
That's a good one, Heidi. That's a great overview. No, thank you. That's terrific. It's interesting. Yeah, there is. I didn't. Thank you for pointing out. There's a humongous difference between the timeshare at $1,450 per thousand, or yeah, per thousand of assessed value. That's an amazing number. Heidi, what's the difference between let's say I guess I'm going to answer my own question. A non-owner occupied would mean like a second home versus a short-term rental, which is a different kind of a non-owner occupied home, right? So a short-term, if you're I guess short-term rental means you're renting out. Well, I think I'm I'm answering my own question here. A non-owner occupied is a home that you, like a second home. Is that basically what a non-owner occupied is defined as, essentially?
Yes, but Maui County did pass a new law last year that properties are classified at highest and best use. So if you're in an area that allows short-term rental, your taxes are automatically going to be short-term rental. So even if you don't rent it out and just use it for personal use for part of the year, as of last year, you are now going to be taxed at that short-term rental tax rate. So non-owner occupied would be if you own a house or a condo in a residential area and that is not your primary residence. And your primary residence is where you file your income taxes as a primary resident. And in order to get the homeowner exemption, you need to file taxes the preceding tax year as a primary resident in Maui County. So it's not instantaneous. It could take a couple years to get that exemption.
Well, my eyes were just about to roll back in their sockets when you talked about filing Form X, Y, and Z for the previous year and not having it valid until the second year, and it goes into effect in the third year, but you have to wait for the property that. Good. Thank Heidi. Excellent details. Thank you. And you know what? It's not just me. Patrick appreciates it. Heidi, great overview of the property tax estimate for Maui. Thank you. Patrick, we appreciate it. Tax is a very, very dry topic, and I'm my ADD kind of kicks in, and so we're going to move on and let's hit the big on over here. Dylan, give us the quick overview. How do you calculate how would you kind of go about some rule of thumb stuff for calculating property taxes on the big island?
The first thing, and I guess the Hawaii County property tax people aren't as smart as Maui because ours is way simpler to understand. So the first thing is they confuse you by doing this, like, $11 per $1,000 of tax assessed value. Really, you just move the decimal point one time to the left and it's a percentage now, right? So if you want to think about it like how normal people think about taxes, it's a percentage. So on all of these numbers over here, you just move it one time to the left. So for example, the residential rate there, the second one down, if you go one time to the left, it becomes 1.11% or 1.3, what is that, 6%. So that's the one kind of confusing thing is for the Big Island, there's two different rates based on the valuation. So if it's under $2 million, you pay that 1.11%, but the portion above $2 million, you pay that 1.36%. So that means if you have a $2.5 million house, you pay the one rate on the $2 million, and then on the $500,000, you pay the higher rate. That's kind of new. They did that last year, I believe. But really for the Big Island, you have all of these different rates, but there aren't like short-term rental, long-term rental, all that stuff. It's either you pay the residential rate, which means it's not owner-occupied, or you pay the homeowner rate, the one all the way at the bottom, number 9, and that means you do owner-occupy it. So if you owner-occupy it, you get a $180,000 exemption off the assessed value, plus you pay the lower 0.615%. So it's almost half, the tax rate is almost half as if you pay the full residential rate. And you pay that full residential rate, doesn't matter how you're using it, short-term rental, long-term rental, second home, whatever. As long as you're not your primary residence, you pay that residential rate. So those are the two that'll affect most people. All this other stuff, industrial, commercial, you're usually not going to be affected as a consumer unless you're a business owner and own that type of property. But that's kind of the short rundown on property taxes on a Big Island. They're not that complicated, but the important thing to understand is, one, like Heidi said, how are you going to use it? Because that's going to affect the rate. And looking at a property online today and you see what the property tax rate is doesn't mean it's going to be your property tax rate. So you do want to figure out, okay, how am I going to use it? And the assessed value is almost always going to go up once it sells, because that's one of the things. Assessed value very much lags the market. So you could be looking at $1 million house that's assessed at $600,000 that has a homeowner's exemption on it, and so the taxes may be like $1,200 and look really cheap, right? But then if you buy it at $1 million and then you're going to use it as a second home, now you're going to pay 1.11% on a valuation that's going to be closer to $1 million, because they're going to reevaluate that soon after the property sells. So your tax rate could be $10,000, right? It could go from $1,200, but today to $10,000 when you actually take ownership of it.
That's a really good point. You really got to look at how it's going to be evaluated and what the rate's going to be. So Dylan, the big like you said, the issue here is residential and homeowner. Homeowner means you're living in the home. Residential would mean it's a home you've got that's not where your primary residence, and then there's that graduated tax rate of the first 2 million, almost like your income taxes. Got it. Interesting. Got a couple of questions that are popping in. Actually, Dan, quite relevant. Does Hawaii reevaluate the property regularly? Yeah. So Dan, as you've all, one thing that's interesting here is that there are different laws for the different counties, or in this case, the islands. So each of the county has their own laws. So Dylan, from what I heard you say, the property, does it get reevaluated more than just when it's sold, or does it get how does the reevaluation work for property tax assessment purposes?
And if it's something that was owned for a long time, the valuation may go up 2 or 3 or 4% every year. So there's a small kind of incremental increase every year. But again, the market, when you've seen the last couple of years go up 15-20%, that valuation hasn't caught up to that. So the county assessed value is usually going to be much lower if the property's been owned for 10 or 20 years. But once you sell it and they see the new sales price, they're gonna reevaluate that based on somewhat closer to that sales price. There is a lag in that happening though, because the county only does an assessment once a year, and then the change in rates only happens once every 6 months. So for example, and this happens often, and this affects your ability to buy in terms of your financing, right? Because the loan officer is going to look at the current taxes. So if it's currently paying the full residential rate, but you're going to homeowner be a owner occupant, they're going to base your principal, interest, taxes, and insurance on your payment on what the current taxes are, even though they will go down once you own it. But usually for the first about 6 months, you're going to pay whatever the previous owner's tax rate was, because the tax rates only change every January 1 and July 1. So, if you buy the house in February, you're going to pay that old rate until it gets changed in July 1st. So there will be some lag. Complicated, but yeah, it's not going to happen immediately.
Yep, got it. Thanks, Dylan. So, Patrick, this is we're going to hit this one next. So, Patrick says, so Scott, does a 200K exemption apply to Oahu? Again, we're going to find out because Oahu has a different tax law.
Big Island's 180. Big Island's 180,000, so it changes from island to island, and it actually goes up after you go above 70. If you're disabled, there's a bunch of other exemptions that can get piled onto
All right,
that.
man, my eyes are rolling back in their sockets. My ADD is kicking in. I can only handle so much of this stuff. All right, so let's go on. Let's move on to the next one here. Let's see. Why don't we let's do why don't we do this, gang? So there's a bunch of questions that I've got in. I got one from the Spot Kaunakakai. We're going to take that one in a sec. Kev, I got yours too, and Andre. Andre, I've got yours too. So stand by. We're going to take everyone's questions one by one. But first, let's hit the Honolulu County tax chart. Scott, why don't you give this an explanation of what's going on over here?
Yeah, so I'll talk a little bit about residential in general. So we're 3.5 cents per every $1,000 for assessed value if you're an owner occupant or primary resident. So $1 million property, it's $3,500 for the year, which is very affordable. If you're non-owner occupant, meaning either second home or you rent it out, and that's going to be long term, obviously longer than 90 days now, then you're up to $1 million gets taxed at 4.5 cents per every $1,000 of assessed value. So $4,500 for $1 million, and then anything above $1 million jumps to 10.5. So if you're non-owner occupant and the more expensive that property gets, the accelerated the property tax rate increases significantly over $1 million because of the 10.5 cents. Otherwise, the property taxes are really low. It's when you get into hotel and resort and stuff like that that the city and county wants to get their hands into that. Tourism money effectively is what it is, and for hotel and resort it's $13.90. So it basically quadruples, right? Yep. Otherwise, there are home tax exemptions. If you buy and you're going to owner occupy it, you have to file a form, and there's different home tax exemptions. Basically, a discount on that property tax rate, and it's based on your age. So there's a whole matrix for that. Most people forget when they close on the property. You can't file it until you close. Most people forget to file it after they close. So then you don't get the exemption.
Interesting. So what kind of stands out here is how and I hope you all see an appreciation for this. Scott, what again was the exemption amount? The home exemption amount for Oahu?
It's either 180 or 200. The top. I mean, there's a whole scale depending on your age.
Got it. So 180 or 200, depending on age. And again, you have to file Form 25, followed by Form 26, and make sure you do it before Form Z of year 5. But anyway, that's all beside the point. What really kind of sticks out to me is as I ran through this was that, how different that the rates really are. I mean, not just the structure, but how different. I mean, look, the Oahu residential, let's look at if you lived in, for those of you who live in Hawaii, on Oahu, it's 3.5%. On the Big Island, it's 0.6%, right, Dylan? 0.6%. You move the decimal point, so it's less than 1%, 0.6%. And on Maui, if you're owner occupied, it's 2% at tier 3, which is over 1.5. So Maui could be anywhere from it's about 2.5% or so. So
it's actually just 0.25%.
I'm sorry, 0.25%. Thank you.
0.2%. Yeah.
0.25. Wow, that's right. Huge difference. So Maui is 0.25%. Big Island, if I got this right, for residential is 0.6%, and Oahu is 0.35%, right? If I got that right. So interesting. They are different, and they all have different needs, and it's gradual. So what this means, gang, what does this mean to you? Do you have any questions on taxes? I'm just about at my limit as far as I can handle that kind of stuff. Well, why don't we take a little mental break over here and hit some questions up. Let's see what we got here that came up. We got first of all, I got a comment from Auntie Joyce. Also, owner operated by owners qualify as kupuna. There is another break in property taxes. We love the discount. Great. Another kupuna is the local Hawaiian word for the senior discount. So there is I didn't realize there was a kupuna discount.